Picture this. The world's financial systems are walking a tightrope, teetering between extraordinary opportunity and catastrophic collapse. In the midst of this uncertainty, one of Wall Street's most respected voices, Jamie Dimon, CEO of JP Morgan Chase, has issued a stunning warning about an impending meltup. This isn't just a market correction or a typical bubble burst. It's a phenomenon that could send prices soaring before everything crumbles. So what exactly does Dimon mean by a meltup? And more importantly, how should you position yourself for what's coming? Stick with me as we unravel Dimon's insights and decode how this dramatic financial scenario might unfold. Number 1, what is a meltup and why Jamie Dimon is sounding the alarm? A meltup isn't your average market rally. It's a euphoric surge that defies logic, fueled by unchecked greed and fear of missing out. It's the moment when investors throw caution to the wind, pouring money into assets with the hope that prices will keep rising forever. And then, just as quickly as it begins, it collapses, leaving devastation in its wake. Jamie Dimon, the CEO of JP Morgan Chase, has raised the alarm about this very phenomenon, warning that we could be heading straight into a market frenzy of historic proportions. Dimon's concerns stem from the dangerous cocktail of factors driving today's economy. He points to persistent inflation, aggressive government spending, and growing global instability as the catalyst that would spark this financial wildfire. This isn't the first time Dimon has predicted trouble. During the 2008 financial crisis, while others underestimated the risk, Dimon steered JP Morgan to safety, earning his reputation as one of Wall Street's most trusted voices. When he speaks, it's wise to listen. Let's rewind to the late 1990s, the dot-com bubble. Tech stocks skyrocketed as investors blindly chased companies with no real profits, no solid business models, just lofty promises of the digital future. Pets.com, a now infamous example, saw its stock surge despite burning cash at an unsustainable rate. When the bubble burst in 2000, the Nasdaq lost nearly 80% of its value. Trillions of dollars vanished, wiping out retirement accounts, life savings, and businesses. Dimon sees eerie parallels today. Except this time, it's not confined to tech. It's everything. Cryptocurrencies, meme stocks, overvalued real estate, and even high-growth companies are experiencing inflated valuations. The euphoria blinds investors to the risks, creating a false sense of security. And yet, beneath this glittering facade lies a fragile foundation. Dimon warns that once the sentiment shifts, the crash could be swift and brutal. He's not predicting doom for drama. He's laying out a clear and present danger. The meltup isn't about celebrating financial highs. It's about recognizing the storm brewing on the horizon. For those caught unaware, the fallout could be devastating. But for those who prepare, there's a chance to emerge not just unscathed, but stronger. If you're enjoying the video, hit the subscribe button and comment down your thoughts if you want to explore money-making strategies. Click the link in the description to start your financial journey. Number 2, what's driving the meltup? The concept of a meltup, where markets surge to dizzying highs before a potential crash, doesn't just appear out of nowhere. It's the result of several forces converging, and Jamie Dimon, one of the sharpest minds in finance, has been vocal about what's driving this precarious ascent. Understanding these forces isn't just fascinating. It's crucial if you want to protect and grow your wealth in turbulent times. Let's start with the massive influx of liquidity into the markets. Since the pandemic, central banks worldwide have injected trillions of dollars into the financial system through stimulus packages and low interest rates. This easy money environment was designed to stabilize economies, but it's also fueled unprecedented speculation. Picture this. In 2021 alone, retail investors poured over $1 trillion into the stock market, a record-breaking surge. Suddenly, everyday individuals with little investment experience were chasing gains in meme stocks like GameStop and AMC, driving their prices to astronomical levels. These moves were more about hype than intrinsic value, creating a bubble waiting to burst. But it's not just retail investors fueling the fire. Institutional players, mutual funds, hedge funds, and pension funds are chasing returns in an environment where traditional safe havens like bonds offer little to no yield. With interest rates historically low, money is flowing into riskier assets like tech stocks, cryptocurrencies, and even speculative ventures like NFTs. Companies with no profits or even clear business models are being valued at billions. Think back to the dot-com bubble in the late 1990s. Companies like Pets.com saw their valuations skyrocket based on hype rather than sustainable fundamentals. We're seeing echoes of that era today, only amplified by social media and lightning-fast digital trading. Another powerful driver of this melt-up is investor psychology. The fear of missing out, or FOMO, is at an all-time high. When Tesla stock hit new highs in 2020, some investors mortgaged their homes to buy in, convinced they'd never see such an opportunity again. These emotional decisions create a self-perpetuating cycle. Rising prices attract more buyers, which pushes prices even higher, until the market becomes detached from reality. Lastly, geopolitical uncertainty is playing a surprising role. While tensions typically cause markets to pull back, some investors view certain regions, particularly the US, as a safe haven amid global instability. This has funneled international money into US markets, further inflating valuations. What's alarming is that all these factors, excess liquidity, speculative behavior, FOMO, and geopolitical influences are pushing the market toward unsustainable levels. Dimon's warnings aren't about a sudden collapse. They're about the risk of a long overdue correction that could catch many off guard. If history is any guide, melt-ups often end with a painful wake-up call. The question is, are we paying attention this time? Number 3. What can you do to prepare? Preparation for a melt-up doesn't mean panic. It means strategy. When markets soar irrationally, the real winners aren't those swept up in the frenzy, but those who position themselves wisely, avoiding the traps of greed and fear. Jamie Dimon's warning isn't just a signal of caution. It's a challenge to think like a chess master, planning several moves ahead. Take the example of Howard Marks, the billionaire investor known for his deep understanding of market cycles. During the 2008 financial crisis, Marks didn't run from the chaos. He leaned into it. His strategy? He prepared well before the crash by holding cash reserves and identifying undervalued assets. When others were selling out of fear, Marks bought at rock-bottom prices. The lesson is clear. Preparation isn't about predicting. It's about being ready for any scenario. When the melt-ups shifts to a meltdown, will you have the liquidity to take advantage of the bargains? Now consider a less glamorous but equally powerful lesson from everyday households during the same crisis. Those who lived within their means, prioritizing savings over lifestyle inflation, were the ones who could weather the storm. While extravagant spenders faced repossessions and bankruptcies, frugal families emerged with their financial stability intact. Frugality is often seen as boring, but in volatile markets, it's nothing short of a superpower. Diversification also comes into play here. Picture a table balanced on multiple legs. If one leg fails, the table still stands. This is exactly how Ray Dalio, founder of the world's largest hedge fund, approaches investing. During the 2020 pandemic crash, Dalio's all-weather portfolio demonstrated how spreading investments across asset classes, stocks, bonds, commodities, and real estate can shield wealth even in uncertain times. Diversification ensures that if one sector crashes, your entire financial structure doesn't collapse. Debt management is another pillar of preparation. Think back to the housing bubble of 2008. Families with over-leveraged mortgages lost not just their homes, but their financial futures. On the other hand, those with manageable or no debt had options. Dimon has often highlighted the importance of reducing high-interest debt before chasing market highs. The math is simple. You can't build wealth if you're hemorrhaging money on compounding liabilities. And then there's the overlooking yet critical role of staying informed. Legendary investor Peter Lynch built his career by investing in what he understood, avoiding hype-driven assets. Today, in a world of meme stocks and cryptocurrencies, the same rule applies. Do you truly understand the companies or sectors you're investing in? If not, you're gambling, not investing. Finally, preparation isn't just about finances. It's about mindset. When markets climb excessively, fear of missing out can push even rational investors to take reckless risks. The key is to stay disciplined. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." In a melt-up, patience and preparation become your greatest allies. In the end, preparing for a melt-up is about staying grounded while others lose their heads. It's about understanding that the market's euphoria is temporary, but the decisions you make now will define your financial future. Will you be the one ready to seize opportunity or the one swept away by the tide? If you like this type of content, then press that like button and subscribe to our channel.